I will tell you that you've got to be able to stay ahead of inflation. And the two asset classes, let's talk about this. Historically, the two asset classes that have always helped people stay ahead of inflation are equities and real estate. Right now, real estate is the shining star. Real estate portfolios that we are using here at Gen Wealth have done exceedingly well in this inflationary time period, and probably will continue to do so because they are well positioned to take advantage of inflationary situations. Now, that's not a promise or anything of that nature, and there's a lot of qualifications to being in a real estate portfolio that it's for a particular type of investor, but it is an asset class that we use here at Gen Wealth. Equities have been on a tremendous run up until December of last year, and they will go back to having a tremendous run at some point in time in the future. Equities have to be part of your long-term portfolio.
Yeah, and I think we haven't even brought up the bond component of this, right? Because you were talking about the 60-40 portfolio.
Yeah.
It has been beaten up this year. So when you talk about real estate, I think to myself too, boy, this really, times like this, in a rare time where stocks and bonds are going the same direction, because it doesn't happen often, certainly not to this magnitude. Rising interest rates have certainly affected the bond prices, and that's why bonds have been beaten up the way they have. But it highlights the value of a diversified portfolio, unlike probably any time in recent history. And that real estate is the added component, because people do talk about a diversified portfolio and they just think stocks and bonds. Those are not the only two asset classes available.
Well, in recent history, we have seen the S&P 500 become the golden child of investing, because it was going up so much. Large cap growth stocks were on a tremendous run, and so everybody was like, I got to be in the S&P 500. I got to be in the S&P 500. But if all of your money is in the S&P 500, you're now 20+% down from your all-time high. Yeah. And if you need income off of that, now you're having to sell 20% more shares to generate that income than you would have back at the all-time high.
Or take a 20% pay decrease, like the example we were going through earlier. And again, it goes back to the importance of having an advisor who will segment your assets so that you're not all in the S&P or all in real estate or whatever the category might be. You've got to have diversification. The reason all of these different asset classes and groups exist is that there is a time and place in different situations to use them. It's not that one is good and the other is bad. You need to determine what your needs are in terms of income and solve from there on what products are going to meet those needs.
Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.